Welcome to This Week in Money. I'm Phil Mackesy. Today, Doug Casey on the future for gold. Dan Denning looks at the oil market. And Shaun Broderick covers all the action in metals. We begin with Doug Casey right after this.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Doug Casey is founder and chairman of Casey Research, and you'll find him online at CaseyResearch.com. Doug, welcome back to This Week in Money.
Pleasure, Phil. Thank you.
Casey Research in Toronto next week, frozen Toronto at the PDAC. Monday morning, Marin Katusa and Louis James talking about exploration and resource stocks. Market's up today, but look what's driving activity here, Doug. Unemployment benefits hitting a 4-year low, consumer spending up, better February sales. Is that healthy or normal for markets to react to that kind of stuff like they are?
Well, the problem is this, is that the government, the Federal Reserve in the U.S., but this is true all over the world, actually, Europe, Japan, China, they're creating trillions more currency units. And as some of that trickles down to people, of course, there's more money in their pockets and they spend and so forth. But the delayed effect of that is going to be vastly higher prices and a destruction of the currency. So look at it this way. We're just entering the other side of the hurricane. We entered the hurricane in 2008. We've been going through the eye of the storm now. And with them printing up all this extra money, which is making things look good for the moment, things are going to get really ugly within the next year.
As we go.
No, I wouldn't pay any attention to these happy numbers, because the general standard of living has been dropping for the last 10 years at least, and it's going to continue dropping, I'm sorry to say.
Mm-hmm. As we go into the other side of the hurricane, a lot of folks pointing to gold falling off a cliff yesterday after Bernanke said, no, he's not going to bring out the punch bowl again. Do you think Bernanke killed the gold rally? What's happening here?
Well, first of all, it's a big mistake to rely upon any statements made by government officials. Sometimes they lie outright. Sometimes they're misinformed. So I don't really pay much attention to that. And as far as the future for gold is concerned, we've got to remember it's not particularly cheap anymore. Mm-hmm. This isn't the days when it was $400 or even $600 or even $1,000 an ounce. So up around where it is now, $1,700, $100 fluctuation is almost like a random fluctuation.
Yeah.
It's not cheap, but I'm afraid it's going higher because they are going to create trillions more currency units, and people are going to go into gold increasingly from fear and from prudence, not so much from greed to make profits. But even foreign governments in up-and-coming countries like China and India in particular are buying huge amounts of gold, and I wouldn't be surprised if in the next decade or less, the Chinese in particular come out with a gold-backed yuan, because we're going to need something to replace the U.S. dollar as an international reserve currency. And that will be gold, but I suspect it'll be a Chinese yuan, too.
Doug, seems to be a whole lot of lack of consensus about what's affecting gold. Here's just a quick spin around the dial here. Reuters says it's the European Central Bank. Wall Street Journal says it's Bernanke. Business Week says it's Iran. Forbes says it's profit-taking. TheStreet.com says it's U.S. housing data. All of these things affect gold, or what really affects gold?
Well, look, these are all just opinions.
Yeah.
And if you're in the business of publishing a monthly magazine or a daily newspaper, you've got to have some kind of opinion. on what's going on. But the fact is, daily fluctuations, weekly fluctuations are random, and nobody could really be sure what's moving the market because the market consists of millions of people, and you can't get inside all of their heads. But the way I look at it is this: is that we've entered upon something I call the Greater Depression. The Western world has been living way above its means for decades, and we're kind of having a comeuppance. And gold is an indicator of that people don't want to have paper assets.
Mm-hmm.
The economy's unsound. They want to own money in its most basic form, something that you can keep in your own hand and it won't be inflated away. In fact, it'll profit from further inflation. So looking at it from a long-term point of view, which I think is the only way that makes any sense, that's why gold is at the level it is, and I'm afraid that's why gold is going considerably higher.
Doug Casey, our guest on This Week in Money. Here's a great quote, Doug, from Ron Paul yesterday, questioning Chairman Bernanke over at the House. He said when Bernanke first took over as chairman of the Fed in 2006, an ounce of silver would buy 4 gallons of gasoline. Today, it buys almost 11 gallons of gasoline.
And actually, I like silver even more than gold.
Okay.
Because it's a smaller and more volatile market. It's kind of the poor man's gold. It can be used as money and has been historically, but both of them are 2 of the 92 naturally occurring elements, and both of them have increasing industrial uses, and this is even more true of silver than of gold. So, yes, even at the plus $30 level, I'm afraid I still have to be bullish on silver.
Let's talk about oil for a second again, Doug. Here's a quote from Donald Trump, OPEC, setting the price of oil and laughing at us because we have no leadership. How come this got to be President Obama's fault?
Well, first of all, Trump may have been successful in highly leveraged business dealings, but he doesn't know anything about economics, and he's a complete whore when it comes to politics. So I see Trump as being a successful entertainer more than anything else. OPEC doesn't set the price of oil, and Obama doesn't set the price of oil. The market sets the price of oil. And the fact of the matter is that from a strictly geological point of view, we've reached a phenomenon called peak oil, which means that all of the easily discoverable, easily retrievable, light, sweet crude has been found. In fact, the amount of that kind of oil that's been found has been going down considerably for 40 years. So I expect the price of oil to stay high and go higher. Now that's not to discount the fact there's plenty of oil in the world, but it's in the form of the tar sands in northern Alberta, and it's in the form of very heavy oil in Venezuela and oil shale in the United States and deep sea oil. So all that oil is available. There's hundreds of billions, trillions of barrels of the stuff. But it's going to become more and more inconvenient and more expensive to access. But Trump and Obama and OPEC, it's got nothing to do with what these people say.
Doug, you can't talk about oil without talking about Iran and the tensions that are building there.
Right. And it seems to me that there's an excellent chance that the U.S. or Israel is going to provoke a war with the Iranians, which is incredibly stupid.
Mm-hmm.
And nobody can say with 100% certainty that's going to happen. But one thing that we can say is this: is that when economic times get tough, governments like to blame somebody else for the problems they have. It's not our fault. It's the fault of those damned Iranians. And really, war is a nice distraction for them.
Mm-hmm.
And there's also this meme that's been going around for many years that says the war is good for the economy, which is idiotic. It's the worst thing possible for the economy. So what's going to happen there? I think there's a reasonably high chance of a war with Iran, and maybe it'll just be accidental for all we know, because of some local hothead and things get out of control. But it's not good unless you're long oil, because I think oil is likely to go higher.
Doug Casey, our guest on This Week in Money. Meanwhile, Doug, in the Eurozone, the ECB's second liquidity injection, $700 billion in cheap loans, the long-term refinancing operation, LTRO. Maybe we should just call it El Toro, because, it's mostly bull, right?
Yeah, and what's going to wind up happening is the euro is going to reach its intrinsic value. They're creating trillions of good things. It's terrible because it's really on the backs of the European taxpayer. Of course, there are less and less of those things. Seems like the whole continent of Europe is on welfare at this point.
Yeah,
certainly all their banks are. So I think that the problems that Europe is facing are even more serious than the problems the U.S. is facing at this point.
You put that together with talk or lack of talk about QE3, and you can see how this can play into the hands of precious metals, right?
I don't see a better place to be at this point. Really, from a speculator's point of view, there's nothing in the world that's cheap at this point, including real estate. Real estate's come off a lot, but it's been in a gradually inflating bubble for decades, and it's been a real bubble until just very recently. So where are you going to go? I mean, stocks aren't cheap. Real estate's still not cheap. I'm afraid that now's still the time to be buying precious metals.
Doug Casey is founder and chairman of Casey Research. You'll find him online at caseyresearch.com. Don't forget Casey Research at PDAC in Toronto next week, Sunday through Wednesday, and you can get details at pdac.ca. And I want to thank Jeff Brodrick, Doug, for this tip. March 6th to 17th, the Grape Harvest Celebration in Cafayate. That sounds like a lot of fun.
And Jeff Brodrick will be down there with us. I really enjoy Jeff's company, and I'd certainly invite all your listeners to get out of the cold Canadian winter and come down here to Argentina for a harvest festival. It's fantastic.
Should also slip in a mention here for the Casey Research Recovery Reality Check Summit. That's coming up at the end of April in Florida. John Williams from Shadow Stats, Rick Rule, Harry Dent, Marin Katusa, Jeff Clark. A cast of thousands are going to be there. Sounds like a great show.
Yeah, we've got a whole bunch of really good speakers. David Stockman's another one that's going to be there. So but it's a small conference. Even with the kind of speakers that we have, we keep the number of attendees, we cut it off at 300, so that it's possible to get to know all these people in a one-to-one way over the 3 days the conference lasts. So I want to invite people to come down to Miami for that conference, too.
CaseyResearch.com is where you want to go. Doug, thank you for talking to us today.
Well, pleasure's been mine, Phil. Thank you.
Coming up, Dan Denning on This Week in Money.
Always consult your investment professional before making any investment decision.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
Dan Denning is editor of the Daily Reckoning Australia. He is online at dailyreckoning.com.au, and he joins us today from Melbourne, Australia. Hey, Dan, how are you doing?
I'm good, Phil. Thank you very much for having me on the show.
Oil in the headlines today, the situation in Iran getting worse and worse. The UN says Iran's developing atomic weapons, and of course, the U.S. and Israel don't like that. Is the oil market, Dan, preparing for war? What do you think?
Well, it scares me because it reminds me of 2008, where we saw a huge increase in the oil price, and than a crash from 147 down to $34. So for me, when you look at it, you've got to separate the amount of speculation that's going on in the oil price from the amount of geopolitical fear that's in the oil price. And I think right now that's a lot of what's going on. Is people are wondering how this situation with Iran is going to resolve itself, and they're looking at real supply disruptions, and I think that's where the price is. So the bad side is this doesn't look like the sort of thing that's going to the tension with Iran is not going to go away anytime soon. So we might have to endure these prices for most of the North American summer.
Now, there are two kinds of oil, West Texas Intermediate and Brent crude. And you're saying in the latest daily reckoning, you feel Brent crude is overbought.
Well, yeah, I looked at it on a technical basis, and I think to me that's one aspect of it is more than any other commodity, the oil market is commodified, and it's a place where people speculate on prices rather than just being controlled by simple supply and demand. So, anytime you see a story like, for example, today, there was a story that there was a possible explosion at a Saudi pipeline, and West Texas Intermediate went over $110 a barrel. I think with Brent crude, because that's where most of Europe gets its oil, that's what's gone on in the move up to 125, is that people have said this thing with Iran is getting worse, and we're going to start buying oil as a way to hedge against it.
Iran, of course, not the only problem. Other places like Nigeria, Kazakhstan, Syria, Libya, they're all having problems, and that, of course, is affecting supply.
Yeah, you have to, I think when you look at the oil market now, it's interesting. In North America, there's probably a little bit less urgency about it than there was a few years ago, because obviously in Canada there's plenty of energy, and because of the shale gas boom in the United States, there's a lot less worry about what's happening in the Middle East. But really what's happening is that, the region that supplies most of the world's crude oil and that has most of the world's proven crude oil reserves is in a period of incredible geopolitical instability that doesn't look like it's going to improve anytime soon. And I think as investors in the oil majors and people all across the world digest that, they're going to say, you know what, we have to find a different place to get our oil where it's more stable and more reliable. And in the meantime, it's not easy to do. And in the meantime, the oil price is going to reflect the fact that there just aren't a lot of other options right now. We're
talking to Dan Denning from the Daily Reckoning Australia. Dan, this tension between Iran and the West, that has got to be good for China.
Well, I think it is, because in the past few weeks you've seen the Chinese be pretty crafty about it. They buy a lot of Iranian oil, and the Chinese don't interfere with Iranian politics, and this works to their advantage because the more isolated Iran is from Europe and the United States, and the fewer people that buy Iranian oil in Europe, that's more oil for China. I think the Chinese have to be worried that there comes a point where the Western powers try to do something in Iran, and that disrupts the flow of oil to China. But the Chinese are very realistic about where they're getting their energy, so Iran is a big partner for them, and I think that this situation suits them just fine as long as it doesn't escalate.
Day-to-day headlines, Dan, give us real short memories, and we forget what happened 4 years ago. Way back in 2008, when oil went up to $140 a barrel. Walk us through what happened then. What's different now from 2008?
Well, I think what happened back in 2007, 2008 is that because of the liquidity that had been unleashed by the Federal Reserve and the European Central Bank, had low interest rates everywhere, that was really the peak of the global asset bubble in all asset classes. And I think a lot of hard asset and real asset investors were surprised at how much investment money was in the commodities market. So when first Bear Stearns and then Lehman Brothers went bankrupt and a lot of that leverage disappeared in the financial system, it turned out that there were just a lot of leveraged bets on oil prices that didn't have anything to do with supply and demand. And at the same time, because the global financial crisis, as they call it here in Australia, because that resulted in negative economic growth, where you had GDP contracting and very slow GDP, there was also less demand for oil. So you had those two things that happened at the same time. You had a lot of the speculative money come out of the oil market, and then you had a contraction globally, which means that there was just less demand for oil. So I think what surprised people is just how I think the oil price fell almost 80%. So people were shocked that there was that much speculative money in the oil market. I don't think that's likely today, but it gives me at least pause for thought when you talk about whether the oil price can go to 150 or $200. There's still probably a lot of speculation in it, independent of what's going on in Iran.
Dan Denning from the Daily Reckoning Australia, our guest today on This Week in Money in the Eurozone, sharing headlines with Iran today. The European Central Bank coming up with another $700 billion. That's after $500 billion in December. Get this, Dan, in less than 3 months, the ECB has added 10% to the Eurozone's money supply. Wow.
Yeah, well, geez, you wouldn't think that they were bankrupt when they keep coming up with that much money, but obviously when the money comes from nowhere, then there's no theoretical limit on the amount of money they can create. But it's interesting what they're doing. But one of my friends who I was speaking to about it the other day said, what you have to remember is that no matter how much credit is created in Europe, no matter how much extra paper is created to try and save the banking system, none of it creates real wealth over there. All they're really trying to do is prevent the banks from going bankrupt. So you can try and refinance that debt. You can try and restructure it. You can try and selectively default, as S&P says Greece has done. But ultimately, they're still trying to deal with the debt problem by creating more money. And it's interesting to see how they're doing it mechanically, but at the end of the day, I think they're going to fail.
We have some breaking news, Dan. Eurozone says Greece has met all the legal conditions for that new bailout. They'll get just over $200 billion. That avoids a default for now. How is that playing in Australia? What's going on there?
Well, there's actually a very large Greek population in Melbourne. I think it would qualify as the second largest city in Greece.
Okay.
If it was our own population, but in Australia, the main consequence of what's happening in Europe is that globally credit is more expensive. So the Australian banks don't have a lot of direct exposure to Greek debt, but credit is getting more expensive. That's the first aspect. The second aspect is that asset markets, stock markets, bond markets, have obviously been directly impacted by this fear that Greece is going to default and lead to a banking collapse. So if there's a temporary appearance of a resolution to the Greek problem, you'd expect it to be good for the stock market. And in fact, today the Aussie market has opened up. But I don't think that the Greek problem has been solved by any means. S&P said Greece was in selective default, but the ISDA, the agency that regulates whether or not something constitutes a credit event, said no, that didn't happen at all. So it's the people making the rules are sort of changing the definitions as the process unfolds. So I wouldn't expect it to be the last we hear from Greece.
We're talking to Dan Denning from the Daily Reckoning Australia here on This Week in Money. Just scanning through the Australian Online this morning, the headline, Fed's caution puts a dent in the dollar. Did Bernanke's comments hurt the Australian dollar yesterday?
Well, I think I didn't see what the dollar opened up at. Yeah, it's down this morning. It's at 108, by the way, which is, when I moved down here, the exchange rate was 63 cents back in 2005. So it was much more favorable for me as an American. But I think what happened is people aren't sure what Bernanke means. He said that he's not going to think about QE3 anytime soon. And obviously gold didn't like that and the stock market didn't like it. But the fact that some of the economic indicators in the States were more bullish was positive for stocks. I think the Aussie dollar is basically, I wouldn't say it's decoupled, but right now it's one of those risk-on trades that there's a lot of global speculation in the Australian market. And if they want to make a bet on commodities, if you want to make a bet on emerging markets, and if you want to make a bet on interest rate differentials, the Australian dollar is really your best vehicle for it. And that's why the Aussie-US currency pair is the fifth most traded currency pair in the world, even though Australia has a GDP of $1 trillion. So I think the Aussie dollar will continue to be kind of a vehicle for speculation, and that's what's happened overnight with Bernanke's comments.
Dan, gold is big news in Australia, just like it's big news here in Canada. Any effect in Australia of the gold price dip yesterday?
Not much. I mean, obviously the stronger the Aussie dollar is, it kind of caps the the appreciation in the Aussie dollar gold price. So even though the gold market, we always talk about the U.S. dollar gold price. For investors here, the strength of the Australian dollar has made gold less attractive to them. Of course, if the dollar crashed by 40 or 50% as it did in 2008, that would change. But gold is not an asset that's really discussed that much here in terms of bullion. Gold stocks, on the other hand, are, as in Canada, very popular, and I think there's a lot of activity around the producers here, and people are very excited about them.
A lot of folks excited about a big year for oil exploration stocks in Australia this year. A survey just released by the Australian Bureau of Statistics saying the resource sector on pace for an 85% increase in investment spending this year. So that's got to be good news, if it's true.
Yeah, well, there's a difference between the plans companies make and whether they can find the money to actually do it. And in Australia, the other issue is labor. It's people forget it's a big country. Continentally, it's the size of the lower 48, but there's 22 million people, and their wages in the resource sector are very high. The booming states are Western Australia, where there's a lot of mining and iron ore, and then Queensland, where there's a lot of coal and LNG. So there are real limitations to the number of projects that can get done based on borrowing the money and finding the people that can actually execute the project. So, and of course, my worry is that a lot of the projects that are slated are based on this projection of demand for commodities from China and India and Asia that may be a bit rosy. But for now, of course, they can't dig the stuff out of the ground fast enough. So people are very excited, and they're planning on building more stuff. But oil and gas is interesting because those markets are, as we were talking about before, Korea, Japan, China, they're looking to diversify their energy supplies away from the Middle East, so they're not so dependent on what's going on in Saudi Arabia and Iran. Australia's directly benefited from that in terms of the offshore LNG, and then lately some onshore unconventional gas exploration.
What do you make of this? Treasurer Wayne Swan, I guess that's the equivalent would be a finance minister here in Canada. He says the statistics figures showing the increased spending, a resounding vote of confidence in the economy.
Well, I always distrust politicians as a matter of course, because they're using the resource cycle and the super cycle and commodities as a way to justify their economic management, when really they're just along for the ride in this case. And typically when they start crowing about things, it means you're closer to the end of the ride than to the beginning of the ride. So that's what you'd expect him to say, but I'm not sure that the policymakers in Australia have an appreciation for just how much commodity demand has also been influenced by the global credit bubble. So they might be surprised that if we have some deleveraging across the world associated with what's going on in Europe and, of course, the United States, that ultimately that means that the people who make things in Asia are going to sell fewer things in Europe and America, which means they're going to need fewer commodities from Australia. So I'm a bit bearish about it, but you'd expect him to be bullish because, that's he's a politician.
That's his job.
Yeah.
Dan Denning is editor of the Daily Reckoning Australia. He is online at dailyreckoning.com.au, and we always like to hear your perspective. Thank you, Dan.
You're welcome very much.
After the break, Shaun Broderick on This Week in Money.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at TalkDigitalNetwork.com.
Shaun Broderick is editor of Red Hot Global Resources and Crisis Profit Hunter from Weiss Research. Check out Shaun's blog at uncommonwisdomdaily.com. Shaun, it's always good to have you back on This Week in Money.
Hey, thanks for having me on.
Hey, I guess the thing we are focusing on today, all this week, silver and gold have been on a heck of a ride. As we're speaking here midweek, silver off $2 from yesterday, still more than 30% below last April's high. What's going on with silver now?
Well, one thing you have to remember is we have options expiration coming up, and it looks like after the breakout in silver that we saw on Tuesday, where we saw silver go up 4.5%. It looks like there's a concerted bear raid to drive silver back down. And so we'll just have to see where it goes. Certainly, this doesn't put a good weekly close in play. You know, I mean, it looks kind of bad. But we'll just have to see what happens. The news that people are actually hanging this on is that Ben Bernanke actually mentioned inflation when he spoke to Congress.
Okay.
So they're saying, well, if he's worried about inflation, we aren't going to have any more free easy money from the Fed, and so that's a reason to sell gold and silver. I think it's more of a bear raid. That is, the big forces that like to keep a lid on the price of silver are using this as an excuse. And the fact that we saw, you know, the SLV and like other funds that hold physical silver run up in the morning before this happened, only to come crashing down, just gives the example that someone's really trying to push this around.
Yeah.
And so we'll just have to see how it goes. Stocks haven't been hit that hard. And in fact, when you look at the broader market, it's actually holding up pretty well. I don't think they're worried so much about the easy money aspect over in the broad stock market. So it's mainly precious metals, energy a bit more also. And but, you know, we have to really weigh this against the fact that we had good economic news this morning. And in fact, the economic news generally has been improving. And so things seem to be, you know, all in all, I think things look pretty bullish. We'll have to see how this week ends for precious metals, though.
Okay, so the 1 week window is not enough to really give us an insight into the trend. What's the longer term trend for silver? Any idea?
Well, it's still in this miserable range and, since last year when things really fell apart for silver. I mean, it's in this big range. It tried to break out of it yesterday. It got slammed down. So we'll go back into the sideways trend until we see something, you know, really fix here. Maybe if we're lucky, you know, and you never know. We could get really lucky. We could see something happen. If we're really lucky and we've really been good little kids, then silver could pull back to maybe $27. I don't see that happening. 33 will certainly be support that we will probably test, though not necessarily, because right now, as you and I speak, silver still isn't below the 200-day moving average.
Okay.
Maybe it's a one-day sell-off, which would kind of fall in line with that bear raid that I'm talking about, because if they can't turn it around here, then it's probably going higher. I mean, silver has recovered from the big sell-off that it had earlier in the day. We still have to see how it will close. So if the bears can push silver below the 200-day moving average, then support at 33 is the next thing to look at, and we'll see if that holds. But they still have to prove themselves today. I mean, yes, it's a really bearish move that they're having here, but the volume isn't even that strong. Mm-hmm. So I'm just not that worried about it right now. What I would like is a nice pullback for a few days so I can just line some things up. There are things that I want to own that I don't.
Sure.
And so I would just add those on a deeper pullback. Maybe I'm lucky. Maybe I'll actually get one.
We're talking to Shaun Broderick from Uncommon Wisdom Daily here on This Week in Money, and gold also pulling back a little. Depends on who you listen to. Just a selection of comments here from Reuters. Gold steady after ECB cash injection. Wall Street Journal. Gold retreats on Bernanke comments. Business Week. Gold futures rise on IMF warning. Forbes. Gold sees mild losses on profit taking. And TheStreet.com. Gold prices waver on U.S. housing data. Are they just picking these out of a hat?
Well, no. I mean, we actually saw things rise this morning, and so I think that's what the earlier headlines are from. And then things really fell apart after Ben Bernanke's speech. The fact that the ECB made that injection, maybe people took that as, well, okay, now they're done. Now it's time to really sell gold and like stuff like that. So it's hard to really figure out. I mean, I have taken some gains recently, and so I'm okay with like just waiting to see if we get lower prices. I do think gold and silver, especially silver probably, will have a very good year. If we are seeing improving economic news, not only in the U.S., not only in North America, not only in the Western Hemisphere, but around the world, and it seems we are seeing improving economic news, then it should be a great year for silver because it's an industrial metal as well as a precious metal. And gold, I mean, since gold was at 1900 and it's fallen off since then, central banks have created about $2 trillion worth of money. The surprising thing to me is why gold isn't higher.
Mm-hmm.
And I guess that could be part of it, actually, is some people are kind of, disappointed gold really hasn't moved, and so they aren't seeing the move there. So they're moving on to, like, other things now. Maybe we're seeing some of that as well. But I still think there's plenty of liquidity in the system, and you put that together with an improving economy, and we could really see sparks fly in the whole precious metal space.
Shaun, not surprising this week, an announcement from Iran that it's going to take payment from trading partners in gold instead of those hated Yankee dollars. Is that going to do anything to gold?
They say they'll take payment in gold. The thing is, who wants to give them gold?
Yes.
I mean, they'll probably take it in iPads, too, at this point.
Sure.
No, yeah, they don't want to take it in dollars. They want to take it in gold. We'll see what they'll take it in. They might have to take it in muffins. I mean, I hate the fact that people are really beating the drums for war with Iran. What we should have learned from Iraq is that there must be other ways to solve these things, and I hope that they do. That said, it's not like they're the most likable bunch of people in the world. Not Iranians in general. I mean the people running the Iranian government. Mm-hmm. And so in some ways they're their own worst enemies. I hope that we use this as an opportunity to improve our energy production here at home, which we are, by the way. So that's good. I think that's actually going to be a big boost for the North American economy going forward, is we have such cheap natural gas here that it becomes cheap to manufacture a whole bunch of different things here. And so I think we'll start to see a economic boom because of all this cheap natural gas we have.
More with Shaun Broderick next on This Week in Money.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
Shaun Broderick, our guest on This Week in Money. It's also been a milestone week in the markets. NASDAQ over 3,000 for the first time, and the Dow closing above 13,000 for the first time since way back in 2008.
Well, that's NASDAQ's touched 3,000 for the first time since the year 2000. However, let's figure in inflation. If you figure in inflation, the NASDAQ would have to get over 3,900. So I think there is some sense of relief. People figure, finally we're getting back. But on the other hand, you wasted 10 years, and well, actually more like 12 years. And also, counting for inflation, you really aren't making it. That's how buying an index kind of works against you. That's why I like stocks that pay nice dividends, or I like precious metals because there's real value there, and they tend to outperform. Though precious metal stocks themselves have been beaten down into the dust, and so just recently they have pulled their heads up, but I think they have a lot higher to run, especially as we see gold and silver go higher. I also like energy stocks. I just gave my Red Hot Global Resources subscribers 3 energy picks yesterday, and I think that there's a lot of potential there. We all know that higher gasoline prices eventually can impact the economy to such an extent that it can cause another recession. We aren't at that point yet, though. I think we have some real space between here and there, and I think we could see oil easily hit 120 this year and maybe higher than that. And there are a bunch of companies that are making a tremendous amount of money, so the small cap energy space is a space people really should be looking at.
Gas prices up 8% in the last month or so. What's driving that? Obviously, Iran has got to be a big part of it.
Fear over that. Yeah. People also blame speculation. That is true to a point. Also, even though we're using less energy here in North America, the U.S. refiners and producers are exporting tremendous amounts of gasoline, heating oil, other petroleum products, exporting that to other countries around the world, mainly Mexico, but also places in Europe, also China. And so we are in a global market now, and that's only going to get worse in 2016 when we're finally able to export natural gas. But so even though we're using less gasoline, for example, U.S. drivers used 8.9% gasoline in the most recent month compared to a year earlier. That doesn't have the impact that you might usually expect of, okay, that's going to lower prices a lot. No, it doesn't, because they take the surplus gasoline they have and they sell it to people in emerging markets. People in North America are now competing with people in the emerging markets for every gallon of gasoline they want to buy. And so that's the kind of thing that can really keep a floor under prices and make some of these companies just so darn profitable.
Somebody suggesting this morning online that the signs of an improving economy are boosting gas prices, that the fact that the Dow closed above 13,000, that has something to do with gas prices. Do you think that's valid?
Yeah, I mean, that's where you get the speculation in there.
Yeah.
Absolutely. People are speculating that we are going to have a improving economy, and it's not just the floor traders that are actually doing that. It's also all of those big companies that will use fuel in the future. They have to hedge their bets. They say, we'll be using so much jet fuel, so much gasoline in the future. We need X amount, so we'll hedge our bets and just hedge purchasing that going forward. So in case the price spikes, we won't be put out of business. And so that's the general trend you see in this, is as the economy improves, they have to buy more of it.
Is any of this Bernanke's fault?
I know people love to blame him for everything, including the weather. Only in the way that you can say, all this excess capital sloshing around the system has to go somewhere, and it often ends up in commodities. That said, I believe that an expansionary policy was called for when they were really worried that the economy was just going to crack and fall apart. And so that was basically his response, was to create money to actually, there are worse things that can happen than paying high gas prices.
Sure,
in fact,
sure.
If the economy goes to hell, you'll be paying much lower gas prices, maybe. I mean, if the global economy really goes off the rails, but then you won't be happy because then no one has any money. So there are worse things than high gas prices. I
should mention Bernanke's talking to Congress right now, giving him his semi-annual report on the economy. It's kind of a bad news, good news thing. He says the bad news is the job market is far from normal, household income is flat, and credit is way too tight. But there is some good news. He saved 15% on his insurance with Geico. Thanks, Ben.
Yeah, well, and also he had kind of a staring contest with Ron Paul. It was actually pretty good theater while it was on.
Hey, nice.
They only had it on TV for a short time. I don't think they want the rest of us to know how the rest of the world works. And but again, I mean, a lot of that happens in Washington is actually theater. It doesn't matter who's in the White House. And it's a lot of this stuff goes on, but the end result will be the same. That said, I believe that the economy is proving in North America. That does tend to point toward higher prices for fuel, but it's okay because we'll have more money, sloshing around, people having jobs, that kind of thing. So I'm actually okay with that.
Shaun Broderick is editor of Red Hot Global Resources. Check out Shaun's blog at uncommonwisdomdaily.com. And you can find Shaun on Twitter at Shaun Broderick. Don't forget Shaun's best-selling book, The Ultimate Suburban Survivalist. If you have somebody with a special occasion coming up, it makes a great gift. It's available in paperback at Amazon.com. And don't forget the Money Show in Vancouver. That's about a month from now, March 27th and 28th. And we look forward to seeing you there, my friend.
Okay, I look forward to seeing you anytime, Phil. It's always great to see you, and I always like speaking to your listeners, so thanks.
Our thanks to our guests, Doug Casey, Dan Denning, and Shaun Broderick. And thanks to you for listening. I'm Phil Mackesy. For AmericanManganeseInc.com, we're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.